The Fed staff just said that the odds of a recession are 50%, and the market is priced for 0% recession odds. People believe that the U.S. economy has become recession-proof. In recessions, weak assets get transferred into strong assets. Economic activity is declining slightly. Now, you know what people say to me? They don't focus on the word declining. They focus on slightly.
Can you explain stealth recession?
Well, I don't know what a stealth recession is. You're in a recession or not a recession.
What about small business owners?
Small business sector is being hurt very hard by not fiscal policy, but by monetary policy.
So where do you think we sit now?
I think the recession is actually already starting.
So who do you think is going to feel it the most?
Well, I think that unfortunately.
All right, David, how are you today, sir?
Doing pretty good. Thanks for asking.
And you're right. The S&P 500 is soaring now. What do you think is some of the cause for that?
You know, it's an interesting question because all we've done from this huge rally off the April lows is apparently taken off the table what's referred to as tail risk, like really bad outcomes. For example, it looks as though now we're not going to have a global trade and tariff war.
Okay.
Check. It looks as though we're not going to have World War III coming out of the Middle East. Check. It looks like we're not going to fall off the fiscal cliff as this big, beautiful budget bill works its way through Congress. Check. So we've managed to eliminate bad outcomes. So you could say, well, therefore makes sense for the stock market to maybe go back to where it was before all these tail risks started coming into the system, back in March and into early April. But now we've hit new highs. Now we have hit a new all-time high on the major averages as of today. And it is a little puzzling because it's one thing to price out bad news. But normally in a rally like this, and especially a rally so powerful, you know that the price earnings multiple, which is now between 22 and 23, has expanded 4 full points over the course of the past 3 months. Do you know how often that's happened in the past? Data back to 1990. So we're talking about 35 years of data. It's happened the grand total of 0.4% of the time. This sort of market action is what we refer to on Wall Street as a forced standard deviation event.
Wow.
So it's like if you've been long this equity market, you're talking about a 4 sigma event. It's like I just held a lottery ticket.
Wow.
So it's unusual because normally you come off a depressed low in the stock market. There's usually a catalyst that doesn't just involve, we're not all going to get crushed. We came off the lows during the pandemic, for example. Tremendous fiscal stimulus, free checks for everybody with a pulse. The Fed cutting rates to zero and opening up its balance sheet to almost everything under the sun. And then, of course, we had thought that a vaccine was going to take 5 years to come. And Pfizer Monday came in November of 2000. Well, so we had a bunch of, shall we say, positive catalysts that propelled the market from those lows. You come off, for example, the Great Financial Crisis. The lows were in March of 2009. That was not a case of, say, averting a calamity. There was part of that because TARP recapitalized, and I guess you can almost say saved the banking system. So you say, that was something that was avoiding Armageddon, that was not necessarily creating positive news, but just avoiding a disaster. But of course, we had at the same time tremendous fiscal stimulus and the Fed easing monetary policy under Bernanke like it was nobody's business. So you did have positive catalysts every step of the way. You go back to when I started in the business. I started my first day as a street economist was October 19th, 1987. I'm not so sure you were even born then.
I was a baby.
And the 23% collapse in one day. And everybody thought it was going to be Armageddon. But what happens was the Fed cut rates, flooded the system with liquidity. And then within a few months, we're back off to the races. But we're not getting fiscal stimulus, right?
No.
The Fed's not cutting interest rates, right?
Right.
There's not been some cure for cancer, right? It's like all basically, Donald Trump tooketh, and then I guess he gave it back by just not walking us through all these different landmines. So it is perplexing as to why the market has managed to go back to a new all-time high. I had no problem with the premise that, well, the market's bouncing nicely. But hitting a new high requires good news, not just bad news being removed. So I am skeptical over the longevity and the extent of the rally we're seeing right now. I think a lot of it is just, classic stock market behavior. I talked about the price earnings multiple really being back to where it was at the highs last February. Rare has been the day that the multiple has been as high as it is today. Valuations are important. Yes. Fundamentals are important. Yes. Market positioning is important. Yes. For anybody who is a market seer that actually monitors and forecasts the stock market, you can't just stop there. As great or as bad as the fundamentals ever are, or valuations being high or low, there's other things that drive the stock market at any given point in time. And we have to keep in mind that the stock market is a psychological beast. It is a market that is driven by the two extremes of fear and greed, right? I mentioned how I started in the business in October '87. That was the same year that Wall Street, the movie, came to be with Gordon Gekko. Remember, greed is good.
Yeah.
Greed is good. Greed and fear are the two primal emotions. But you see, the stock market is a behavioral animal. It's driven by sentiment and psychology and momentum. And right now, that is really what's propelling the market higher right now. I guess some people call it the greater fool's theory. If the market's going to go up, it will continue to go up. So I have to pile in. So you get what's called the herd mentality. So I think that's what's happening right now. It doesn't always have to make sense. But you see, because I am an economist and I am wed to the fundamentals, and I am seeing the whites of the eyes of the recession, by the way, which is not priced in because nobody believes they're going to see one, I think there's going to be a day of reckoning. But this is one of those periods, and we've seen it in the past, where sentiment and emotion, animal spirits, as John Maynard Keynes called it, can dominate the market action. Doesn't mean I'm going to participate. I'm not a day trader. But that's what's happening right now. We have a tremendously confident, exuberant, enthusiastic market on our hands right now. So it's all basically psychologically based and nothing more than that.
Can you explain stealth recession?
Well, I don't know what a stealth recession is, so I can't define it. It's like you're in a recession or not a recession. It's like I could not explain to you a stealth pregnancy. You're either pregnant or you're not pregnant.
Okay.
So when it comes to the recession, there's no shades of gray, right?
Okay.
So you're either in one or you're not in one.
So where do you think we sit now?
I think the recession is actually already starting. Okay. And this is what makes it interesting, because part of this move in the stock market is because people don't believe that there's going to be a recession. That's part of the sentiment and psychology. And I'll tell you why. It's because we were supposed to have a recession in 2022 and 2023 when the Fed dramatically raised interest rates, classically inverted the yield curve, always a recession indicator. We didn't get the recession 2022, 2023. We were supposed to get the recession, didn't get the recession. So therefore, people believe that the US economy has become recession-proof. That's part of the mentality, psychology, sentiment that I'm talking about. If you believe that the US economy is no longer vulnerable to a recession, if you think that the business cycle has been repealed, if you believe that Mother Nature has suddenly had a coronary and is no longer alive, well, then this market is for you. But that's what people believe. I'm just looking at the data. I'm looking at the GDP data, and then we have monthly data on GDP through to April. And I could see that real GDP has declined, not slowed, actually declined in level terms in 2 of the past 3 months and in 3 of the past 5 months. And the year-over-year trend in real GDP this time last year was 3.2%. It has receded to 1.3% as we speak. And when I started in this business, I keep on going back to show people how old I am. Back in the mid 1980s, if we got down to the low ones on GDP growth, I would be asked the question constantly, when's the recession starting? And today people say, oh, we're down to 1.3, but it still has a plus sign in front of it, right? So that's the mentality, still has a positive sign. Here's the problem is that when you look at real GDP on a 3-month or 6-month basis, the growth has fallen below the zero line. Now, there's this big debate on Wall Street right now between what's called the soft data and the hard data. The soft data being anecdotal data, mostly survey data. And the hard data is what I'm talking about, GDP and retail sales and housing starts, industrial production. That's the hard data. And the Fed's been saying for a long time, well, we know the soft data has been very soft, but we're going to wait till it morphs into weakness in the hard data. And the soft data has been soft for well over a year. All the different survey data, survey of service providers, of goods producers, of consumers, of home builders. And in fact, there's got to be 30 different surveys that come out every single month. And at my firm, we rolled that into a model to map out what is that consistent with GDP, because GDP, after all, is the entire economy. And the survey data right now, in its completest form, is telling us that the economy is contracting at almost a 1% annual rate. Now, I said before that the year-over-year GDP is 1.3, but the nearer term trends, the momentum, 3 and 6 months, is actually turned fractionally negative. So I'm noticing that the soft data is finally morphing into weakness in the hard data. And I'll tell you that you don't have to take my word for it. I know that the markets aren't priced for a recession. There's no asset class priced for a recession right now. But you look at this thing called the Fed's Beige Book. And I don't know if you know about the Fed Beige Book or any of the viewers know about the Fed Beige Book. So it's called the Beige Book because the cover is beige. So I'll get that over with first.
Okay.
The Fed Beige Book, okay. I would recommend, whether you're in the financial markets like I am or not, it comes out every 6 weeks. And it is the most comprehensive assessment of the U.S. economy across regions and across sectors. And I'd say whether you're a day trader or whether you're a business person, everybody should read the Beige Book. It is so rich in information.
I'm looking at it now, and
yeah,
it is beige.
It comes out. We just got one for May. It comes out every 6 weeks. There you
Find that
go.
latest one.
It's a very nice. You can see nice. I guess it's sort of beige. It's hard to say.
Well, it's called the Beige Book, so I mean,
it's called the Beige Book. So look, it's been released since 1970. Okay, and actually, have a read of it. Maybe after we finish this, you'll see what I'm talking about. Okay, I'll tell you what. Go on the Beige Book. Read out the first sentence of this Beige Book. Yeah, you want to get through. That's just like telling you what it is. I'm talking.
Okay, overall economic activity.
Yes, just read that one sentence for the viewers.
Reports across the 12 Federal Reserve districts indicate that economic activity has declined slightly since the previous report.
Aha! Declined slightly.
Wow.
Declined slightly. Not expanded slightly. The Beige Book itself. Now, the Beige Book, this is all the people at the Fed go out into the field. Right. And they survey business people across the country. For all I know, the folks that are on this call, maybe the Fed contacted them. I don't know. Right. This goes back to 1970. Let me just say that we ran some data science over this, and the tone of this Beige Book was weaker than the one that came out in December of 2007. Which was the first month of the Great Recession. And back then, it was like hunky-dory. It was what they call, I guess when you call stealth recession, is what economists call the soft landing. Right. Growth slows, but we don't end up contracting. And a contraction is important because that is an actual haircut on the economy. That is not slow growth. That is not taking the automobile from 80 miles an hour down to 20. That is going in reverse. And that is something completely different. That's why they're called recessions. Okay, there's recessions, expansions, and then there's deep recessions, mild recessions. There's huge expansions, mild expansions. It doesn't matter. Okay, it's like I'm 3 months pregnant or 8 months pregnant. You're still pregnant. Okay, or you're not. Back to your earlier question. So when you go and read the next sentence in that Beige Book.
Half of the districts reported slight to moderate declines in activity. 3 districts reported no change. 3 districts reported slight growth.
So the only parts of the economy that are growing slightly, not robustly, not buoyantly. And what they just told you in real time, and this is not hard data. This is what's called part of the soft data. This is part of the survey. But the thing about the Beige Book is that unlike GDP and unlike retail sales and unlike non-farm payrolls, the Beige Book doesn't get revised. This is in real time. What folks on the ground in the weeds of the economy are telling you. And like I said, they've been doing it since 1970. That second sentence just told you that 3/4 of the US economy is either in contraction or stagnation mode. And so you're going to ask me, am I a believer in the stock market rally? Well, I'm an economist. I'm not a technician. How could I be a buyer of this market knowing what the Beige Book just told me? Because corporate earnings are part of the economy. And they just told you that the economy is contracting slightly. And whenever they've used those words in the past, we've been in a recession. So I don't know if it walks like a duck. You know what I mean?
Oh, yeah.
We actually had a situation where at the May Fed meeting, now we just had a meeting last week. This is the meeting before 6 weeks ago, because we have the minutes of that meeting. And then in a few weeks, we'll have the minutes of the meeting that just happened. But at the minutes of the May meeting, now, the FOMC minutes always start with the Fed economic staff, economic overview and forecast, and then they get into the deliberations from the actual policymakers led by Jay Powell. But what they hit off with is the Fed staff economic projection. Now, you can go to the FOMC minutes if you want. I'll have to navigate you through to get to the right page. But I'll just basically save everybody some time and just say that what did the Fed staff do at the May meeting? Well, they took down their GDP growth forecast. Now, their base case forecast is not recession. They just took down their growth rates to smaller positives. They took down their forecast for this year and next year, but they said, the Fed staff said that the odds of recession are equal to their newly minted lower base case GDP forecast. Hello? The Fed staff just said that the odds of a recession are 50%. Now, I'm not going to say that the Fed economic staff is gospel, but I think we should probably pay some attention to it. And in the Wall Street arena, can you find any asset class right now that is remotely priced for 50% recession odds? Like I basically said earlier, I think it's already starting. The Fed staff, they are usually a very cheery bunch. Just said that the odds of recession are equal to their new minuscule positive growth scenario. And the market is priced for 0% recession odds. Zero. And I don't know anything in life. You asked me before about the stock market. It's a great way to talk about it. What in life is 0 or 100? I have to have my base case forecast. I think the recession's starting. I can't guarantee it. It's my base case, but it's not the only case. The Fed staff tells you, well, they're halfway there towards the recession call. But you have to go with the stock market, which is breathing a lot of helium, 0% recession odds. So when people say to me, I got to buy the market now. It's going up. It's setting new highs. I'm just saying, do you understand? Like, it's priced 0% for a recession, zero. And that is basically, in other words, called throwing caution to the wind.
All right.
By several multiples. So I'm a little worried when the day of reckoning happens.
What do you think in terms of right now government spending at the U.S.? I know that they're trying to reel back government spending. I just interviewed a law firm, and we're concerned that they may not spend what's been appropriated by Congress.
Mm.
You know, what do you think could happen with that? Because when we spoke yesterday about it, she said that we've never seen this before, but what the Trump administration is looking to do potentially is use some old laws to not spend the money that's been appropriated by Congress. She called it a pocket rescission was the words, and they brought up the Anti-Impoundment Act. Two things I had never heard of before.
Well, what can I say? It's like fun and games are over. Do you know that the level of federal government spending today is 53% higher than it was just before the pandemic hit?
I didn't know that.
53. So I understand everybody is so concerned about the spending cuts. You see, that's the thing. You're a business person. You keep on giving your employees a raise and a raise and a raise and a raise, and then all of a sudden you realize I'm impairing my margins. And you could have given your employees a 50% wage increase in a 5-year period. And God forbid, if you cut them back 5%, they're going to go ballistic. So you're talking about spending cuts from like levels that are really hard to understand, like $2 trillion deficits year in, year out. When I started in the business, a $200 billion deficit was considered outlandish. We're 10 times that level. And people are nervous about spending cuts. Now, the spending cuts are going to hurt the economy. There's no doubt about it, but fun and games are over. How do you think we managed to have this 5-year economic expansion, coming off the pandemic? Mountains of government spending, mountains of fiscal stimulus, but it's unsustainable. Like, you're talking about government spending, government borrowing. The government doesn't really produce anything. The government doesn't really add to productivity. But we built up this machinery. It doesn't matter who's in power. It doesn't matter who's in Congress. And so, yeah, we're going to be seeing spending cuts. The question is magnitude. And of course, they're working through this bill right now, the Senate is, but there's going to be spending restraint. And then there's going to be some offsets from, no tax on tips and no tax on overtime and no tax on Social Security, all the things that Donald Trump campaigned on. But when people talk about the future deficits, those future deficits are not real. They're not stimulus for the economy. Okay. It's again, what I talked about before, we're avoiding a potential economic disaster. Now, maybe it's an economic disaster that we need, because all the fiscal numbers that have everybody concerned, and the rating agencies concerned, and the CBO concerned, is extending the 2017 tax cuts that sunset at the end of the year. That's what's most telling and, I guess, concerning from an economic standpoint. Pick your poison. So there's a move afoot to ensure that these tax cuts that were supposed to expire when they first got legislated. But like I said, everything is permanent. Tax cuts in the United States become permanent when they're first passed. They're temporary, become permanent, and the spending becomes permanent. And the next thing you know, we're running year after year after year of like 7% deficit GDP ratios, or $2 trillion year in, year out. We become almost numb. I mean, really, if I told anybody 10 years ago, this is going to be the new state of affairs, $2 trillion fiscal deficits, nobody would have believed it. And we become almost immune to it. We develop an immunity to these. This is like part of life. But it's at some point it will become a problem. Okay, because the government's not a business. The government's not a business. Businesses can run debt. but they run debt to fund capital spending. And the hope is that the capital spending generates productivity and revenues. The government is not the business sector. So I think you're right about the spending cuts, and they're going to be painful. There's going to be some offset from some of these targeted tax relief measures. But the big deficits are really coming from the fact that they're not going to allow these tax cuts to expire. It's not really a tax cut. It's just maintaining the status quo. And then on top of that, the debt servicing that's coming along with it, the extra incremental interest charges on the mammoth level of debt. And this is what has me concerned. When people talk about, cutting spending, I understand it's going to be difficult. But keep in mind, spending is 53% higher than it was pre-pandemic. We built up this machinery, and even trying to dismantle it is going to be difficult because it's going to create pain. But it's going to create pain benchmarked against where I was last year, not where I was 5 years ago. Right? Like, this is not sustainable. What is not sustainable is we have a situation where it's about $1 trillion now of interest charges on the debt. $1 trillion. I mean, so now it's basically overtaken the Pentagon budget. So we're spending more on interest charges than on national security. And most people don't know that we are getting close now to interest charges overtaking Medicare. Half the deficit now is interest payments on the debt. That is what you call a structural deficit. This is going to be very difficult to control because the interest charges, unless you default, you have to pay those. And it's crowding out in the future other initiatives the government might want to take. This is part of the problem I have is, what if I'm right on the recession? What if I'm right on that? Usually the government comes out with massive fiscal stimulus, but we've never gone into a recession with the national balance sheet this stretched. They're going to be very handcuffed. Now, maybe the Fed will come to the rescue and cut rates back down to 0 or 1%. I mean, I hope it doesn't get that bad. But the fiscal side is a big source of uncertainty. And like I said before, the stock market is not looking at anything but rose-colored glasses right now. But the spending cuts we're going to be seeing are actually going to be pretty modest in aggregate. They'll hit some areas more than other areas. But I know it's a whole new world, because at what point do you ever see spending getting cut at the government level? Normally, when they cut spending, it's from projected levels. But you're right; these are from actual dollar levels. This is going to hurt some people, but it's not like we're coming out of this with a deficit and debt situation that is manageable. It's becoming increasingly unmanageable, and I would say that the less they do now on fiscal restraint, the more they're going to have to do down the road.
So who do you think is going to feel it the most?
Well, I think that unfortunately, a lot of the spending cuts are going to be hitting the lower end of the spectrum. Like if they go after Medicaid, and I'm not going to get into the politics,
Right.
I'm not going to get into whatever fraud and waste and abuse, but it's actually going to hurt. Maybe somebody, it's going to hurt the little guy, and I guess the little gal. It's really going to be, what's happening right now on the fiscal side is going to be quite regressive, in my opinion. Even if you account for, no taxes on tips, it's going to be regressive. And then, of course, if you're in the market for becoming a border official or an immigration officer, your future is very bright.
What about small business owners?
Well, small business owners, I would say the fiscal side is going to be neutral. I wouldn't say whether it's going to be good or bad. I think what the small business sector is obviously most nervous about is whether or not we are going to enter into a tariff war. And I think that the small business sector is susceptible to these punishingly high interest rates. That's what worries me about the small business sector. And I'm glad you brought it up, because, here I'm talking about the S&P 500, which are the big giant companies, the NVIDIAs and the Microsofts,
right,
the JP Morgans. So the S&P 500 is at a new all-time high, as you and I are sitting here speaking today. But the small cap stocks, the S&P 600, is still 14% below its peak. it's still technically in a correction. So when I'm talking about the stock market breathing fumes, I should correct myself and say, well, it depends which of these animals you're talking about. The small cap stocks have lagged well behind, and that's, of course, the reflection of what's happening in the small business sector. Small business sector is being hurt very hard by not fiscal policy, but by monetary policy. And I think that, the president, I don't think he just, based on his character and his personality, he can't contain himself. He feels the need to verbally chastise and insult Jay Powell. Now, I also think Jay Powell is making a policy mistake by dragging his heels on interest rate declines. But I would discuss it with him privately if I was president, and not because it's self-defeating. It's one thing to allow your frustrations to be known, but the Fed is always going to guard its independence more than anything else. That is its lifeblood. So every time that Donald Trump criticizes Jay Powell openly, causes Jay Powell just to dig in that much more, because he cannot be seen to be kowtowing to the president. That said, that's what I'm most nervous about when it comes to the small business sector, because they rely, you see, the small business sector cannot go to the financial markets,
right,
and issue gobs of debt. They rely on lenders. They rely on the banks.
yes,
And interest rates are just far too high. And so that becomes a financing difficulty backdrop for many in the small business sector. I think the Fed will cut rates aggressively. It might not be till next year, and I think by that time it might be too late. Of course, the Fed is concerned about the tariff effects on inflation. I think their concerns are overblown, but those are their concerns. But if you're going to ask me, what is the single biggest concern I have for small businesses? It's their ability to service their debts as their cash flows slow down because of the recession, and with no help from the Fed. Like in the past, you got down to, let's say you're right. Let's say this is a stealth recession, 1% growth. Now, I said before the 3-6 month trends are negative, but let's say, okay, Dave, you said year over year, 1.3, it's got a plus sign. It's not negative yet.
right.
But it was 3% plus this time last year. Like either way, either your cash flow is going to be impaired, absolute, or certainly, on a growth basis, but yet your interest charges. So your interest coverage ratio is going to deteriorate as a small business.
Yeah.
And so I think that the Fed should be cutting rates. They're not going to cut rates in July, I don't think, but hopefully by September they will. But that's my biggest concern, because the big companies can withstand that a lot more than the small companies. So it's the financing aspect of it. The fact that interest rates by the Fed's own admission, this is what's incredible. The Fed's own admission, interest rates are at least 125 basis points above their so-called equilibrium level. They're 125 basis points above the level they should be at if the economy is at full employment, which you could argue it is, and stable inflation, which I'd argue we are. The Fed funds rate should be at 3 or lower, right, as opposed to 4.25, 4.5. So that's my big concern. My big concern is more about monetary policy. And look, the Fed is governed not by robots, not yet anyways, but by real people, right? And they're sort of caught in a box in the sense that they still feel this collective guilt and shame from missing transitory on the inflation call in 2021 and 2022. They still feel, it wasn't the 1970s. It wasn't a full decade of inflation, but it was 18 months going from like 0 to 9%. Who saw that coming? Certainly. And so they still feel that their credibility was hampered. And then there's the timing of this, which is Jay Powell's expiry date as chairman is May of next year. So time is running out. It's less than a year. And you got to put yourself in his shoes. Does he want to go out being remembered as Paul Volcker, who killed inflation, albeit with back-to-back recessions in the early 1980s, or Arthur Burns, who gets blamed for the stagflation of the 1970s. Well, there's no statues of Arthur Burns anywhere, but there's monuments to Paul Volcker everywhere. He is like the gold standard of central banking. So I think that Powell's playing with fire, but it's a matter of, call it half hubris and half legacy preservation. But I do believe they're dragging their heels too much on this. And that's what worries me about the small business sector is, will they be able to stay alive in time between now and the time the Fed starts to really cut interest rates?
Yeah, I want to say something to that, and you're right. As someone who, we work with thousands of small businesses, one of that's a challenge that one company in particular, I can tell you, they did over $10 million in revenue and didn't make a profit because of the interest rates.
Yeah. And look, the small business sector typically, I mean, is more highly levered than your typical
Right.
big company. And like I said, I completely agree with you. It's like you read the Beige Book, and you can see the pain out there. Now, there's no pain for the S&P 500, but the S&P 500 is 500 companies.
Right.
I wonder how many people on this call are a member of the S&P 500. It's 500 companies. And the small cap stocks are telling you, as I said before, there's a dichotomy going on here. And I don't know if the Fed has become tone deaf or blind to what's going on, or like I said, they're just, it's become maybe more political. Maybe if there wasn't the tariff threat, and if Donald Trump wasn't badgering the Fed all the time, they might be cutting rates right now. They're sort of so ingrained in preserving their credibility. And I guess I somewhat understand that. But look, you read the first line of the Beige Book. You read that first line. Economic activity is declining slightly. Now, you know what people say to me when I do that line? You know what they say to me? They don't focus on the word declining. They focus on slightly.
Right.
They say, oh, but it's only a slight decline. What are you talking about? It's just a slight decline. That is not a normal state for the U.S. economy.
Right.
The U.S. economy is normally growing. It's expanding. It's not in slight decay.
Right.
And so I say to I say, and what about the Fed staff? Look, if I was in the media asking Jay Powell the questions at the press scrum after these FOMC meetings, I would say, Mr. Powell, why do you expend so much money and resources and time on the Beige Book if you're not going to listen to it? And you do know that your Fed staff believes we have a 50% chance of recession, and yet you're keeping interest rates deliberately 125 basis points above your own estimate of equilibrium. Why do you have an economic staff, all these brilliant PhDs? Why do you have them on staff, and why are you paying them if you don't listen to them? But you see, now you know why they'll never give me a press badge to go into those scrums. They'll never let me in. That much
No,
I can tell you.
you're not getting in like that. No. So tell me, what do you think about AI?
I think that AI is at least as big as the advent and proliferation of the internet and all the web-based applications that followed it. I think that I'm not going to get into the equity market aspect of it or these stocks. I think that there's probably a price bubble, and we got a price bubble back in the late 1990s, early 2000s. But even with that price bubble, the implications that it had on productivity and economic activity, even as these company stocks went down for a period of years, was real and ongoing. And I think that generative AI is a massive game changer. This is and especially what it's going to mean for productivity and the corporate cost curve. You could argue one of the reasons why the market can support a higher multiple than it has in the past. This is a massive game changer. It's only when you think about it, ChatGPT is not even 2 years old. We are in a real fundamental shift in the innovation curve, a really huge inflection point. And I firmly believe that this is as big as, the cotton gin and the steam engine and the railroad, electricity. and it's going to change our lives. It's going to change our lives a lot. And in every sector, what makes it a lot different, and it makes it scary, is that this is no longer about job replacement in manufacturing. This is no longer just about robots in the manufacturing line.
Right.
This is going to eliminate a lot of jobs, and it'll create jobs, but it's going to replace a lot of work in the services sector. It's probably going to eliminate a whole level of middlemen, and it's just starting. And the effects are really unforeseen. There's obviously going to be a major societal upheaval. It's going to be very deflationary. It is going to lead to productivity. There's going to be winners and losers, and it's going to create quite a bit of instability. This is going to be like, I think this is actually going to be more far-reaching than the internet was, and then maybe in some sense more intrusive on our lives. But this is a massive, massive game changer. There's no doubt about it, and it's going to be incumbent on governments to, dare I say, make sure that it's regulated, and make sure that from a social stability standpoint that it doesn't lead to more income and wealth inequality, which is already at unprecedented levels. Certainly fiscal policy hasn't dealt with the wealth and income inequality in the United States. I wrote a whole report on that. Believe me, I am a free enterprise capitalist, but I get nervous when I see any extremes. And that might be one of the biggest risks, is what does AI do to further create these gaping inequalities that we have that nobody seems to address right now. But all that said, the AI wave and the changes that's happening across, whether it's legal industry, the financial industry, the health industry, and it's truly global, is going to have far-reaching implications. And it's going to make, in some ways, our life easier. Just go to ChatGPT and go, have them write your report for you.
Mm-hmm.
Good luck with that, because there's ways you can check that. So it makes life easier, but it's going to make life more complicated. So I think it's going to bring in a period of upheaval. I think we're in the early stages, a period of instability, but it's also going to dramatically reduce costs in the economy. And that's the fundamental positive, because when you bring costs down, you raise real incomes for the economy as a whole. The question will be, how will those real income gains be distributed? That'll be the interesting test.
You brought up the job market. So if I'm here, I'm listening to this, and I'm a 25-year-old kid, what should I be studying in school? Should I be going to school? Like, what kind of career field should I be looking at right now, given all these moving targets, so to speak?
Well, I would say that learn how to code.
Okay.
You'll be first in line to the next job. Everybody's looking for coders right now. Even at Rosenberg Research, I'm an economic financial marketing consulting shop. We are doing more and more data science. So anybody in the line, if you have kids who know how to code, send over their CV to me. Outside of that, and I'm not being tongue in cheek, but I think that I want to have skills. If I'm a young person, that's barbelled. I want to have very strong. So I say coding. I want to have very strong quantitative skills, and they never go out of style, because the quantitative skills gives you the ability to provide forecasts. And in my business, or really in any business, look at meteorologists. You want to have a view of the future. Well, you need to be strong in math. So I would say, and coding is part of that. Knowing how to do econometrics, very important. Knowing how to model, knowing how to build models that will help forecast the future. Like I said before, nothing is zero, nothing is 100, but it gives you a chance to at least build scenarios. And then you can choose which scenario is your base case scenario. But I barbell that, and I actually find this in my own professional life with people that I interview. The young people today, they are very strong in the quantitative side. Now, coding is something totally different. That's almost like a gift. Some people I've met have taught themselves how to do it. You have to have a certain, you have to be able to do the Rubik's Cube in like 5 seconds to achieve that. But what I find, and I would say this to the young people on the call or the people on the call that have kids, because, I've been in the business for 40 years. I've been running teams for 30 years. And I'll tell you what's lacking is the other part of the brain, the creative artistic side of the brain. I find, shockingly, how little the youth know about history. They don't know about history. It's like they've never taken a history course, or they fell asleep, or they were just too busy running algorithms. But you have to do both. And I find that there is actually a deficiency in knowledge of global history. Because when we're talking about forecasting the future, let's just say that we might be smarter. We might be smarter than the cavemen and the Neanderthals. We're smarter. It's all evolution, but we're still humans, and we are prone to excesses. And as I pontificate, you have to know your history, because as Mark Twain accurately told us, if it doesn't repeat, at least it rhymes. And knowing history, especially when you asked me about AI, I wrote a whole report on AI. And actually, I went all the way back to the cotton gin, talking about all the global innovations that have taken place. Don't forget the cotton gin back then. 300 years ago, that was like the internet. The cotton gin, then the steam engine. Think of canals and railways. These are all major innovations. I'll say everything was a major innovation except for tulips. I don't know what tulips in the Netherlands did for anybody, but they probably look pretty in the daytime. So you got to know your history. If you have to know your history, you have to blend your knowledge of history when you're doing your forecasting. And we're always doing forecasting. We're always doing contingency building. We're always doing scenario building. And no matter you mean, your audience is all entrepreneurs, and I am too. We are always looking around the bend. Well, you need that to do the bend. You need the blend, and the blend of quantitative analysis. So I would say to the young people, learn how to code and take an econometrics course, because that's a handy tool to do forecasting on anything. But also bone up on your global history. Take history courses, because that's another tool to know how human behavior is going to respond to these sorts of technological changes. You can't be an expert in AI. When you ask me the question about what's AI's effect going to be, if you don't know history, the history of these major shifts in the innovation curve, if you don't know how this is played out in the past, you're only focused on one part of the story. So take history courses along with your computer science and econometric courses, and then send me your CV and I'll have a look at it.
I love it. Let's talk about crypto now. So what's interesting, I know that JP Morgan filed for a stable coin, and there's a lot of ETFs now around Bitcoin. So, and also recently, and again, I don't know, how I saw a headline about potentially Fannie Mae and Freddie Mac considering crypto as a currency forger applying for mortgages. What is your take on that?
Well, it was always part and parcel of the whole blockchain technology, and facilitating easier methods of undertaking transactions. On our way to becoming, a digital currency economy. I imagine that's where we're headed. I always thought crypto was going to be here to stay. Crypto is here to stay. It is increasingly becoming a medium of exchange. It's obviously increasingly developing both political and institutional acceptability and credibility. So you asked me about Bitcoin. Yeah, well, Bitcoin is increasingly becoming a means of exchange. You could argue that it also provides a store of value, especially given its limited supply curve. So, it's a new and evolving form of technology related to payment mechanism globally. In terms of how to value it, like, am I telling people to go out and buy Bitcoin as an investment? I always found it very fanciful as to why it was called an investment when it's really a currency. Swiss franc is a currency, sterling is a currency, the Japanese yen is a currency. I don't see that there's fund managers out there creating a bucket of, here, invest in my Japanese yen fund. But crypto, for whatever reason, it's all part of the get rich quick scheme. And boy, if you bought Bitcoin at its onset, you've made out like a bandit. I don't know how to value Bitcoin. So therefore, I don't own any of it. I don't own things I can't value. You could say, well, but you own gold. How do you value gold? Well, gold is a hedge against a weaker US dollar. It's a hedge against interest rates going down. It's a hedge against global instability. It has thousands of years of a track record of being a store of value. Bitcoin's a new kid on the block. And I would argue that both share some commonality. Of course, you can use Bitcoin increasingly as a means of payment. I don't see many people going into a cab in Manhattan and paying them the cabbie with gold coins or gold bars. Gold has a lot of emotion attached to it, but it's a lot less volatile. Like, I look at Bitcoin or Ether, for example. I mean, Bitcoin's its biggest correlation is with the Nasdaq 100. Like, it is a risk-on trade. If you're in it, so I'm separating out between Bitcoin as a productive use in terms of financial transactions, as opposed to, should I buy Bitcoin because it's going to go to $200,000? Okay, now it can go to $200,000, okay, or go down to $2,000. The answer to the question is I don't know, and when I don't know, I don't touch it, and I don't mind telling people I don't know. And for investors, it's been a home run, but I believe in a diversified portfolio.
Okay.
So, I want to, if I own the equity market, I want to have some diversification. I want to have other assets that aren't correlated with the stock market. So I might want to own some bonds. And gold is not correlated with the NASDAQ 100, but Bitcoin is. Bitcoin has basically 20 times the volatility of gold. And they call it digital gold. And I say, well, I'll just go buy the real thing. I gave a speech recently in Winnipeg, Manitoba. Now, let me just say to everybody, you do not want to go to Winnipeg, Manitoba in February. Okay, trust me, especially if you come from Florida, because I don't know if you'll be able to come fully equipped with parka and heavy boots.
Right.
Guy in the audience actually says to me, "My mother's birthday is around the corner, and I want to buy her a Bitcoin or half a Bitcoin. I forget what it was at that point."
Right.
He says, "What do you think?" I said, "How old's your mother? How old's she turning?" He says, "She's turning 85." I said, "So I have no problem with you buying her Bitcoin." And there was a hush in the crowd because, I'm renowned as a conservative investor. I don't swing for the fences. I bunt for singles. If I get a double, I'm happy. I said, "I'm quite fine with you buying your 85-year-old mother Bitcoin, so long as you barbell that with a pacemaker. Okay, that'll be just fine."
Yeah. No, an 85-year-old, I wouldn't understand that.
Well, I don't look at Bitcoin as other people do as a get rich quick scheme. I really look at it as being part of the ongoing evolution of the blockchain technology. I look at it more from a fundamental perspective than how am I going to get rich in Bitcoin, because I don't know what the level is. It's not like the stock market. I could have a view of the stock market. I might be wrong, but I can run a dividend discount model. I could look at valuations. I could look at the equity risk premium. I could look at the bond market and look at the term premium, inflation expectations. Where's the economy going? I could look at the corporate credit market and I could say, okay, this is default risk, recovery rates. I can do analysis on that. Well, what's the analysis behind Bitcoin? It's basically it's the volatility, by the way, has been coming down in the past few years, but it's still too too risky for my liking as an investment.
Okay.
Okay. That's for people really who have ice in their veins. So, you know what? I'd rather just go to Vegas with the money and have a good time and get my drinks paid for. There's, but in terms of its credibility, acceptability, there's no doubt that Bitcoin is here to stay. We all know that now, and it's going to proliferate. But to me, I look at it more as how it's going to improve productivity within the broad financial sector than, well, do I buy it at 120,000? Do I buy it at 90,000? Right? To me, that's like, do whatever you want. Just make sure you buy a pacemaker.
Yeah, that makes sense. You talked about having a diverse portfolio. What do you recommend for people to have a diverse portfolio? Kind of some ideas.
Yeah, I believe fully in diversification. I think right now you do want to be diversified, but you want to really cull your portfolio, get it down to best ideas. I would not be buying the market. I would not be buying the S&P 500, the SPX right now. I'd be focused on strongest conviction themes and themes that transcend the economic cycle, since naturally having a recession view. Having a recession view means, do I own consumer discretionary stocks? No. Like, would I own the retailers? Would I own the home builders? No. Would I own manufacturing right now? No. Would I own the financials right now? Probably not, because they're cyclical. But I like parts of the market that are defensive. I like the dividend growth, dividend yield. I'm an economist. My hero is David Ricardo. And I believe in owning what is scarce. I guess you would say that Bitcoin you like because it's scarce. So any incremental increase in demand leads to price increases. And so I would say that, but demand can also go down. I want companies that are stable. Nothing's recession-proof, but companies that are not sensitive to shifts in the economy. I like consumer staples, companies that sell toilet paper. That is not going to go down in a recession. And in fact, because we all tend to crap our pants in a recession, demand for toilet paper probably goes up. So I like consumer staples. I like the tobacco stocks. Sorry for anybody who's offended by that, but fat dividend growth, fat dividend yield. I want the cash flow. I talked about yield scarcity. In the stock market, that means as interest rates come down, which they will, I want to own the bond proxies in the stock market. I want to own yield. I want to own dividend yield, because interest rates come down, you're going to want that coupon in the stock market. I call them bonds and drag. So I like the staples, consumer staples, not consumer discretionary. I like healthcare. I really like utilities. Utilities is my favorite sector. Like, so I'm not going to buy the S&P 500, but I own the S&P Utilities Index. Mm-hmm. Big yield, great dividend growth, and they're actually part of the AI. They're part of the AI. They are part of this building out all these AI data centers, all the power that's going to come from it. I wrote a whole report on utilities. Utilities, actually, if you're looking for a diversified portfolio, guess what? You could just own the S&P Utilities. Do you know why? Because they have bond characteristics and they have growth characteristics all in one sector. Low volatility. They do well in recessions, comparatively speaking, and you get that nice yield and the dividend payout. And so they are defensive growth with yield, perfectly appropriate for the time we're in right now. I would not buy the S&P. I would buy the S&P Utilities. I like staples. I like healthcare. And I like one particular component in the industrials, which is this: aerospace defense. Aerospace defense. And in fact, I would buy the global aerospace defense ETF, because military budgets are going up everywhere in the world. Can you imagine?
Right.
Did you sold a story 50 years ago that the world would be just happy with Germany loosening its fiscal constraints and spending more money on military? and Japan doing the same thing.
Right.
And the whole NATO summit was all about getting to that 5% commitment. It's the one thing that Donald Trump is, you got to give him credit. Military budgets are going up everywhere. That is an area that has tremendous visibility. And by the way, we talked before about AI, and people are saying to me, Dave, you don't own NVIDIA, and you don't own, all the different high-flying tech stocks, which is true. Great companies, I just don't like the stock price. But aerospace defense is part of the AI trade.
Right.
That's part of it. Is there was so much technology, so much smart technology in defense today. This is not old style defense with like tanks.
Right.
This is all, and then you're talking about the next wave is cyber. This is all high tech. You can buy, so people say to me, Rosenberg, you don't like high tech. I say, no, I actually like high tech at better valuations in the defense, because defense stocks have become growth stocks at better valuations. They are tech. And just remember, when you're talking about Silicon Valley, like Cisco is called Cisco because it's near San Francisco, because it's in San Francisco. And when we had the peace dividend back after the Berlin Wall fell, and then the United States was closing all these bases, all these scientists that were in the government went to the private sector. There is no Silicon Valley without the Pentagon. And of course, we're not downsizing the military anymore. It's expanding, and it's all high tech. And so those are my highest conviction themes. I also like gold and the gold mining stock, so I'm not in Bitcoin. Like I say, I don't swing for the fences. The best home run hitters of all time, like Reggie Jackson, were also the biggest strikeout artists of all time. That's not me. I like to play the bands pretty tight. I want people who listen to me, I want them to be able to sleep at night. So I play the bands tight. And all my investment recommendations always are concerned about one thing only, which is minimize the downside risk to the portfolio and capture at least some of the upside when things are going well.
Well, nice. Final thought. What's the smartest move a young entrepreneur can make in 2025?
Know about government contracting but not sure where to start, state, local, or federal? Sign up for a free 15-minute assessment call with one of our coaches. Visit govconeric.com/call, sign up today, and we will share with you our step-by-step formula that we've used to help thousands of students win contracts. Visit govconeric.com/call to sign up for your free 15-minute diagnostic today.
The smartest what?
Move a young entrepreneur can make in 2025.
Well, I'm not as young as I used to be, but I would say that right now, and maybe right now for the next year or two, focus on one thing and one thing only. And that's the one thing that I'm focused on, okay? Liquidity. Because I believe the recession is starting. I can't say it's 100% ironclad because nothing in life is. But you want to have liquidity because after these past 5 years of economic growth and prosperity that all came from the Fed and from fiscal policy, well, the Fed part is unwound. The fiscal part is about to unwind. We're going to go through some tough economic times. I'm very concerned that a lot of people I speak to are being lulled into this false sense of this illusion that there will not be any economic pain coming, and they're not prepared for it. So you want to survive. It's about survival. This is the survival kit. The survival kit in an economic recession is to make sure as a business that you have ample liquidity. And then it becomes currency. Because in recessions, weak assets get transferred into strong assets. So your liquidity will also have optionality when we get to the other side of the mountain, when the recession is over.
Yeah. No. David Rosenberg, thank you, sir. I appreciate you. This is
Thank
great.
you very much.
It's great.